All right, let's break down what makes up your credit score, what it's used for, and some quick tips on how you can boost your score. So in a nutshell, your credit score is a number assigned to you that ranks your likelihood of being able to pay back a loan on time. And a base FICO score can range from scores from 300 up to 850. So we're going to break down which range stands for what, and the higher the score, the better. I personally have a credit score of 805. All right, what are credit scores used for? Most likely they're going to be used for loans or credit card limits. So you have a mortgage lender, that's probably one of the most popular one. It's the biggest reason you want a higher score. It'll help you qualify for a loan and may even decrease your interest rate. Another one is car loans. This is definitely going to be one where they're going to pull your credit score and make sure that you have a good credit score. But honestly, in my opinion, you should try and avoid car loans as much as possible. I like to pay cash for my cars. The only time I like to take out a loan is on real estate. Another one could be credit cards. They might be able to increase your limit if you have a very high credit score. Now, only use credit cards if you pay them off in full every single month. If you are running a balance, you should just cut up that card and get rid of it. All right, let's jump over here and I'm going to show you a few things. So these are your credit scores. It goes from 300 up to 850. Now, if you're 300 to 579, that's poor credit. Means you do not have a good history of paying your bills on time. Maybe you're just habitually late. You're not paying them off in full. Maybe even just, having companies write off your loan because you're not paying it back. That's poor. Now, fair, there's about 17% of Americans are fair. That's 580 to 669. Good credit score is 670 up to 739. Now, a very good score is 740 to 799, and exceptional 800 to 850. Now, exceptional took me a while to get to. I was usually sitting in this very good. Honestly, probably because I'm just young. I mean, I'm 35 now, which some people might not say is young, but I still think it is young. But eventually I got up to that exceptional because I had a little more history, and that's part of what makes up your credit score. So let's break down what makes up your credit score. Payment history is 75%. So this is meaning that you're paying your bills on time no matter what. And obviously you can see that this has the largest impact on your credit score, which makes sense. Lenders want to give money to people who are going to pay them back on time. Now, they don't want to give you money and then have you just be super late, not paying your bills. So obviously that is going to be the biggest aspect of it. Is 35% of your credit score is made up from payment history. Now, 30% is from the amount owed. Lenders don't want to lend money to people who are over leveraged. That means they have too much debt. So if I have 3 car loans and a house loan and a personal loan and all this different stuff, I'm going to have so much money that I owe other people that I'm going to be stretched thin. And that's not what a lender wants. They want the ability to be able to collect the money that they lend you. So if there's 20 other people that are going to be knocking on your door for money, along with them, that gives them competition. They'd rather not have it, right? So this, keep your debt to income ratio low. Now, I've made a video on lenders and how I was able to qualify for multiple mortgages. I'll put a link in the description. That talks about a debt to income ratio a lot, especially in the housing market. They like to see a certain debt to income ratio. They definitely don't want to see you above like that 36% range. Keep it lower, keep your debt to income ratio low. That will keep your FICO score really well. Now, the other one, 15% length of credit history. Obviously, the more history that they have on you, the more they can say, yes, he has not missed a payment in 20 years. That's going to help your credit score because they just have more history. You're not like a 20-year-old kid who's getting his first loan. They just don't know enough about you to give you a high score yet. Now, credit mix, this is just the types of loans that you have. So they want to see that you can pay off. If you have a car, that you're paying it off. You have a credit card, you're paying it off. You have a house, you're paying it off. If they can see that you have multiple different kinds of credit and then you are paying them all off, then it can increase your score. But honestly, 10%, it's a small portion. So I wouldn't say like go get a car loan so that you can have better credit mix. I just don't see that. I don't see the benefit in that because it's not going to bump your score all that much, to be honest. Like on an 800 credit score, 10% is only 80 points. I don't know. It's not super worth it in my opinion. I don't have a huge credit mix and I have an 805. So New credit is 10% as well. So how many new accounts have you opened recently? They're going to look at you and be like, okay, have you applied for 5 credit cards and a car loan all within the last 6 months? Now, if you do that, you are naturally a higher risk person to lend to, because that sounds like you're desperate for cash. And they don't want that. They don't want someone who is just trying to get as much cash right now as possible and possibly overextending themselves. So that is what makes up your score. Now, a quick couple tips on things that you can do to bump your score. Obviously, the number one is going to be pay your bills on time. It may sound stupid, but it's not. Pay your bills on time. Pay off your credit card off in full every single month. Now, if you're not doing that, it is going to hurt your credit score. Now, you would be better off cutting up your credit card and not using it and having it paid off than to have it but not be able to pay it off in full every single month, because that's going to affect your payment history significantly. They do not like that. So pay your bills on time. Now, if you have multiple loans, work on getting one completely paid down. So if you are that person who's like, I have a couple of credit cards, I'm running a balance, I also have a car loan and a personal loan or whatever it is, try and drop that, right? Because if you have amounts owed and you have a huge debt to income ratio, try and drop that a little bit lower. That can have a huge impact on your credit score. So start with the smallest one, get that one out of there, and then go to the next biggest one. Now, this one's actually really tricky, but it's like super simple. Amounts owed, they calculate that off of what you owe every single month. So when you get a credit card statement, that's going to say, hey, yeah, I have, a $16,000 credit limit. And if you have $10,000 that you owe them, that is really high on your credit limit. But sneaky way to just drop that down is right before your statement date, pay off a good chunk of that, if not all of it. You could pay down like $9,000, and then they're going to run your credit score and they'll be like, oh, he has a $16,000 credit limit, but he's only used $1,000 of it. So he actually doesn't owe all that much money, and it's going to bump your score. And I've seen some pretty big swings on this. Like if you just make payments right before the statement date, you can see a pretty decent jump in your credit score. And it's something simple. So that's a quick breakdown and tips that I have. If you have any questions, please hit me up in the comment section. We'll talk to you guys next time.